has been a lot of news in terms of how mutual funds have been holding on to cash. And is it a right strategy to hold higher cash levels for prolonged periods of time? And a constant investor worry is if cash can act as a drag over the long term. So here I would take you through how cash levels have panned out at different points in time in quantum long-term equity value fund, and how as investors you should read our cash levels. At quantum, we don't explicitly state a certain cash level based on market scenario or Sensex or Nifty levels. It is an outcome of our disciplined process which we have been following for many years. When a stock typically hits our sell limits or our estimate of intrinsic value on a 2-year forward basis, we tend to start trimming such positions. And in a raging bull market, it is very much likely that many such stocks could be hitting our sell limits or our estimates of fair value estimates. And as a result, cash would pile up. And there is a possibility that since markets on an overall basis are quite expensive, we may not be finding new ideas where we can redeploy those cash. And as a result, cash piles up. So if you look at our historic data, so you can see that during times of market euphoria, the cash levels tend to build up. So if you look at this chart, here you can see the Sensex levels in the orange line, and you would see our cash levels in the blue bar charts. So whenever markets have turned exuberant, like the periods prior to global financial crisis or the rally which happened when Modi was elected in 2014. So whenever the underlying earnings do not justify the market performance or stock returns, those are the times when stocks would hit our fair value estimates and we would be trimming those positions, and that would result in higher cash levels. And when valuations turn attractive or the cycle reverses, we would aggressively deploy into markets at levels at which we feel the upside potential or 2-year forward return estimates make sensible. We would start deploying those cash into names, into stocks. So as a result, your long-term returns would be enhanced as we deploy those cash. And this can also act as a very good level of good tool for risk management. So if you look at those red circles, those are all times when there has been some events which has led to market correction, and at such levels when the valuations are quite attractive or the 2-year forward returns would look sensible, we would tend to aggressively deploy and cash levels reduce on a dramatic basis. So as an investor, what you can make of the change in cash levels. So in this graph, the orange line, it shows the 2-year forward upside potential. That is the probable returns which the fund could realize on a 2-year forward basis. So historically, what we have seen is this is a fairly reasonable tool in terms of gauging the attractiveness of market or the 2-year forward potential returns from an investor perspective. But it may not work at all times. For instance, during global financial crisis or COVID period, which are very hard to predict and few in nature, those are periods when the estimates on a 2-year prior basis, it may not work. But such periods are very difficult to call out or or even anticipate from an investor perspective. So in a normal scenario, when you see our cash levels declining, like the periods which we have marked in red circles, or even the recent periods when you would have seen a slight decline in cash levels, those are points where the fund manager is perceiving the markets to be reasonably valued, and he's finding new opportunities to deploy cash at reasonable upside levels. So as a result, the 2-year forward return numbers or return potential increases, and that is when you see our cash levels declining. So as an investor, such times would be good indication in terms of increasing your allocation to market so that you earn a reasonable return on the longer term basis. So if you look at even our recent cash holdings, you would have seen a slight decline in cash levels, and the decline in cash levels exactly coincides with the thesis which I just explained. So this is a main takeaway which I would like to leave you with. And as investors, you should also be mindful that when you compare index returns when markets turn into exuberant phase, you should be mindful that index do not have any sort of risk management built into it. It is purely based on the free float market cap which is available to trade, and it does not look at valuations or any sort of risk management matrices. Whereas mutual funds or QLTEVF or funds like quantum long-term equity value funds have a lot of risk management practices. Like one of those risk management practices is this sensitivity towards valuation, and as a result, how the cash levels change over periods of time. So you get a portfolio of stocks which offer sensible long-term return potential, and at the same time, your fund is also cognizant of the overall risk levels in the market, and would judiciously deploy your capital considering all these points. And therefore, it is always better to compare a lot of those index returns along with how the risk management is also handled at a fund level. So there could be periods when markets turn exuberant and your fund might trail the index returns. But those could also be periods where the fund manager has prudently decided to be less aggressive looking at the overall setup. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.